Welcome to a deep dive where we crack open a stack of sources and really dig into a fascinating topic. Today, we're zeroing in on a specific three-day window, June 10th to June 12th, 2025, and pulling out the most important nuggets from reports and research covering global financial markets and economic policy.
Think of this as your shortcut, to understanding some really significant shifts happening right now in the global economy. Our mission is to go beyond just reporting the news and find those key insights, the surprising facts, maybe those aha moments, so you can quickly get informed about what's truly driving markets and policy decisions during this period.
Right, and the sources we've got here, they cover, well, everything from major central bank actions and the latest U.S. inflation figures to shifting trade tensions and some rather controversial tax proposals.
It paints a complex picture, definitely marked by uncertainty, but also showing distinct policy responses and even some, cautious optimism in certain areas.
There's a lot to unpack, so let's just jump right into it.
Okay, sounds good.
Okay, let's start with the big picture, how the global economic landscape looked, according to the latest reports. The World Bank released a pretty significant update during this window, and, well, the news wasn't exactly cheering.
No, not really. What really stands out from their report is the number they put on global growth for 2025. They sharply lowered their forecast to a modest 2.3%. Now, that might sound like just another number, but the context is crucial.
And what is that context? Because the sources make a point of highlighting something specific about that 2.3%, don't they?
They do. The World Bank notes that if you exclude periods of outright global recessions, this 2.3% forecast represents the slowest pace of global growth since 2008.
Wow.
Yeah, that really puts into perspective the kind of headwinds the global economy is facing.
The slowest pace outside of a recession since 2008. That's serious. And was this slowdown concentrated in just a few places or more widespread?
Oh, not at all. The downgrade was incredibly widespread, affecting nearly 70% of economies worldwide, including major players like the United States, China, and Europe. Advanced economies, specifically, saw their expected growth cut to just 1.2%, and the euro area's estimate was reduced to a pretty lackluster 0.7%.
Okay, so according to the World Bank, what's the main driver behind this worsening outlook?
The report is quite explicit here. They link the downgrade directly to higher tariffs and heightened uncertainty stemming from President Trump's trade policies.
Higher tariffs make sense. They increase costs, obviously.
Yeah.
But what about the heightened uncertainty part? How does that specifically impact growth forecasts?
That's a critical point the sources emphasize. It's not just the direct cost of tariffs that's damaging, it's the unpredictability of trade policy itself. Businesses look at this uncertainty and it makes them hesitant to invest, it disrupts supply chains, and it slows down cross-border trade.
Right. Creates a chilling effect.
Exactly. This policy volatility creates a chilling effect. In some ways, the report suggests stable, high tariffs might even be less damaging than unstable, unpredictable ones, simply because the lack of clarity makes effective risk assessment incredibly difficult for companies operating globally.
And who bears the brunt of this? Who suffers the most when global growth slows down like this?
The World Bank is stark on this point, stating, poor countries would suffer the most. Slowing global growth severely impedes developing economies in their fundamental efforts. Creating jobs, reducing poverty, closing income gaps with wealthier nations.
That feels like a potential reversal of development progress. Did the report offer any projections on that front, any numbers?
They did, and it's a sobering projection. By 2027, developing economies' per capita GDP could still be 6% below their pre-pandemic levels.
6% below?
Yeah. And even more concerning, the report citing the World Bank data suggests it might take these countries, excluding China, mind you, 2 decades to recoup the economic losses experienced during the 2020s.
2 decades. That truly highlights a potential widening of global economic disparity.
It really does.
Okay, that gives us a pretty clear, albeit challenging, global picture. Given this environment, how are central banks reacting? We saw a couple of major ones make moves during this period.
That's right. The European Central Bank, the ECB, and the Reserve Bank of India, the RBI, both took action, though with quite different approaches. Let's maybe start with the ECB.
Okay, what did they do?
On June 11th, they decided to lower their 3 key interest rates by 25 basis points. Now, a basis point is just 1/100th of a percentage point, so that's a quarter of a percentage point cut across the board. The new rates are their deposit facility at 2.00%, the main refinancing rate at 2.15%, and the marginal lending facility at 2.40%. And the sources noted this specific cut followed cumulative reductions of 200 basis points. That's 2 full percentage points since June of 2024.
Okay. And what was their stated reason for this cut? What was the rationale?
Well, they cited inflation being around their 2% medium-term target. They forecast 2.0% for 2025, along with moderating wage growth. They also explicitly mentioned a desire to support growth amidst that external uncertainty we just discussed. Their own projection for euro area GDP growth in 2025 is 0.9%, but they added that this outlook is tempered by weaker prospects, specifically due to trade policy uncertainty.
So a measured move from the ECB, explicitly acknowledging the trade uncertainty impacting their outlook. Now let's switch over to the RBI in India. Did they take a similar approach?
Not really, no. The RBI announced a much larger cut of 50 basis point reduction in their repo rate, bringing it down to 5.50%. The repo rate is essentially the rate at which the central bank lends money to commercial banks, and this was their third consecutive cut since February 2025, signaling a more aggressive easing cycle.
A 50-point cut. And I saw they added something else significant to that package, too. Something about liquidity.
Yes, exactly. They also substantially reduced the cash reserve ratio, or CRR, for banks by a full 100 basis points down to 3%. The sources estimate this injects a massive amount of lendable resources into the banking system, approximately $30 billion, or about ours 2.5 lakh crore.
Wow, okay. That sounds like a forceful push. What's driving the RBI's more aggressive stance compared to the ECB?
Primarily, it's about boosting growth prospects. Unlike the euro area, India's retail inflation has remained consistently below their 4% target. It moderated further to 3.2% in April, which is its lowest level in years. So with inflation well under control, the RBI has more room, more flexibility to focus squarely on stimulating economic activity. They even shifted their policy stance from accommodative to neutral to underscore this focus on supporting growth, projecting a pretty robust 6.5% GDP growth for the 2025-26 fiscal year.
That contrast is pretty striking. The ECB is kind of fine-tuning with a 25-point cut because inflation is around target, while the RBI is hitting it with a 50-point cut and this huge liquidity injection because inflation is below target, really trying to position India as a growth outlier, it seems.
Exactly. It highlights the different economic conditions and policy space each central bank has. But what's fascinating, I think, is the common thread despite these divergent actions. Both central banks, the ECB and the RBI, explicitly acknowledge the impact of trade policy uncertainty in their decisions. The ECB noted it would hit business investment and exports, and the context for the RBI's move also mentioned President Trump's tariff threats adding to global uncertainty.
Yeah, that's a really good point. And this really makes you think, doesn't it? If even central banks, with all their powerful monetary tools, are saying trade policy uncertainty is limiting their effectiveness, what does that tell us about the limits of monetary policy in addressing these, well, non-monetary shocks? It almost feels like a fundamental resolution of trade disputes might be more critical for global stability right now than just tweaking interest rates.
It certainly raises that question. How much can monetary policy really do on its own in this kind of environment?
Okay, let's bring the focus back to the United States because we saw some really key data and policy discussions happening there during the same period. The first big one was the latest on inflation, the May 2025 Consumer Price Index report, the CPI.
Right, the CPI report came out, and it had some, well, interesting surprises. The headline, CPI for Urban Consumers, or CPIU, increased a modest 0.1% in May on a seasonally adjusted basis. That was actually slightly softer than the 0.2% forecast by economists.
Okay, and how did the year-over-year figure look?
That came in at 2.4%, which was right in line with expectations. But the core CPI, which strips out the more volatile food and energy prices, also surprised on the downside.
Oh, how so? What did that show?
Core CPI was up only 0.1% month over month, again below the 0.3% forecast. And year over year, it was 2.8%, just below the 2.9% forecast. What stands out here, and the reports really highlighted this, is that this 2.8% figure is its lowest level since March of 2021.
Lowest core inflation since March 2021. That is significant. What specific price movements contributed to that softer reading?
Well, the reports highlighted declines in energy prices, with gasoline down significantly both month over month and over the year. We also saw price drops in sectors like meats, poultry, eggs, airfares, Used and new cars and apparel during May. A pretty broad set of declines, actually.
So putting it all together, this softer than expected inflation data signals some building disinflationary momentum. What does that likely mean for the Federal Reserve and potential interest rate cuts here in the U.S.?
This data definitely strengthens market expectations for Fed rate cuts. According to the reports, markets are now pricing in approximately 55 basis points of cuts by year-end.
Okay, here's where it gets really interesting when you look across the sources, because these softer inflation readings are actually occurring, quote, in the wake of recently enacted tariffs.
Right.
And the reports note that, for now, businesses appear to be largely absorbing the additional costs from tariffs.
That's a crucial point, yeah. It suggests the tariffs haven't fully filtered through to consumer prices yet.
And this ties directly into the political narrative we saw emerge almost immediately. The White House actively highlighted these favorable CPI figures, framing them very positively, claiming America is defeating inflation under President Trump, and pointing out that CPI has come in below economists' expectations every single month since he took office.
It's a powerful political message based on the immediate data, for sure. However, the sources also provide a necessary counterpoint. While the current numbers are favorable, they explicitly warn that tariff risks and corporate pricing warnings persist.
What kind of warnings are we seeing? Are they specific?
Yeah, they are. Recent surveys from regional Federal Reserves paint a clearer picture. They suggest that over half of the businesses affected by tariffs expect to raise prices within the first 3 months. And several major companies, retailers like Walmart and Target, and car makers such as Ford and Subaru, have already publicly indicated potential price increases in the coming months due to these costs.
So the immediate data looks good, supporting one narrative, but there are clear warnings in the sources about delayed inflationary pressures from tariffs that could still show up later. The current price stability might well be challenged down the road. It highlights a potential divergence between immediate political messaging and the more nuanced economic reality.
Absolutely. The full impact often takes time to appear in the data. It's not always instantaneous.
Right. Okay, beyond inflation, another key piece of the U.S. economic puzzle released during this window was data on labor and productivity. How did that look?
That data adds, well, another layer of complexity. Non-farm business labor productivity decreased by 1.5% in the first quarter of 2025, measured as a seasonally adjusted annual rate. And this marks the first decline we've seen since the second quarter of 2022. So a bit of a turnaround there.
Okay, how do we get to that productivity number? Just remind us what goes into it.
Sure. Productivity is calculated as output per hour worked. So this 1.5% decrease resulted from a small 0.2% decrease in output combined with a larger 1.3% increase in hours worked. Basically, if output goes down slightly while people are working more hours, productivity naturally declines.
Was there any positive angle in that report, or was it all negative?
Well, on a year-over-year basis, productivity was still up 1.3% from the first quarter of 2024 to Q1 2025. So it's a quarter-over-quarter decline that really stands out as the negative signal.
Okay, and critically, how does this link to unit labor costs? Because that has implications for businesses and potentially prices down the line.
That's the crucial connection, yeah. Unit labor costs in the non-farm business sector rose significantly by 6.6% in Q1 2025. This rise directly reflects the 5.0% increase in hourly compensation combined with that 1.5% decrease in productivity we just talked about.
Okay, so just to be clear, businesses are paying significantly more for each unit of output they produce.
Exactly. Their labor costs per unit are going up sharply. This can have two main outcomes. It could put upward pressure on prices in the future, what economists call cost-push inflation, as businesses try to pass those higher costs on. Or if they can't raise prices, perhaps due to competition or weak demand, it could compress their profit margins. Either way, the 6.6% jump in unit labor costs definitely challenges the current disinflationary trend we saw in the CPI data. It's a counter signal.
Okay. Let's round out the labor picture then with the May employment report. How did job growth look?
Total non-farm employment increased by a solid 139,000 jobs in May. That was slightly more than estimates, and monthly gains have averaged a pretty steady 144,000 over the last year. So still quite resilient job growth. Unemployment rates remain stable. The standard unemployment rate, U3, held at 4.2%, and the broader measure, including discouraged and underemployed workers, U6, was steady at 7.8%.
And what about wage growth? Still strong.
Year over year, average hourly earnings ticked up slightly to 3.9% in May. So that reinforces the rise in unit labor costs we just discussed. Wages are growing faster than productivity.
Yeah, this paints a really complex picture for the U.S. labor market and productivity, doesn't it?
Hmm.
We have resilient job growth and rising wages, which sounds good on the surface, but it's clearly not translating into improved efficiency, as seen in the declining productivity and rising unit labor costs. That dynamic raises some real questions about future inflation prospects or, like you said, pressure on business margins.
It certainly does. It's a key point of tension in the data right now.
Okay. Finally, during this three-day window, we also saw some significant developments on the U.S. trade and fiscal policy fronts. Let's start with trade. There was some potentially positive news regarding U.S.-China trade talks.
Yes, that's right. High-level U.S.-China trade talks continued, and the U.S. Commerce Secretary actually reported that discussions were going well. More notably, sources indicated a framework to implement a trade deal had reportedly been reached, pending final approval from Presidents Trump and Xi.
A framework? Okay. What did that reportedly include? What are the key elements?
The framework reportedly addresses some critical supply chain issues for both sides. It's said to include China approving rare earth mineral exports, something they have a near monopoly on, particularly magnets used in EVs and other tech, so that's a big deal. And in return, the U.S. would roll back sales restrictions on certain advanced tech goods.
So the aim here is to establish a more durable truce after some temporary tariff reductions back in May, moving towards something more stable.
Exactly. It's an attempt to move towards a more stable trade relationship. President Trump even indicated a willingness to extend a July 8th tariff deadline if needed, though he also suggested extensions might not be necessary if the deal moves forward swiftly.
Okay. How did markets react to these reports of progress?
U.S. stocks remain near all-time highs, partly on hopes for reduced tariffs and easing trade tensions, so a positive reaction there. However, the sources also pointed out that uncertainty still persists for companies. They gave one specific example. Designer Brands, the retailer, actually withdrew its financial forecasts during this period, citing uncertainty stemming primarily from global trade policies.
So some potential positive movement on the big picture, but the uncertainty ripple effect is still very real for individual businesses trying to plan.
Yeah.
Now, let's unpack this controversial proposed U.S. House bill targeting unfair foreign taxes, Section 899. This sounds complicated.
It is, and potentially quite impactful. This measure, which passed the House on Juneteenth, is quite aggressive. It would empower the U.S. federal government to impose a significant 30% tax rate on the profits and income of foreign-parented companies and investors if they're from countries deemed to be charging unfair foreign taxes on U.S. companies. The proposal could even potentially tax non-citizen employees working here in the U.S. for these companies, depending on their home country's tax rules.
Wow, a 30% tax on foreign profits and potentially employees based on this unfairness determination. What kind of economic impact analysis have we seen on this specific provision?
Well, an analysis by the Global Business Alliance, which is a trade group representing international companies operating in the U.S., estimated that Section 899 alone could lead to the loss of 360,000 U.S. jobs and $55 billion annually in lost GDP over the next decade. Their analysis went further, suggesting this specific tax could reduce the economic growth anticipated from President Trump's overall tax cut package by as much as a third.
That's a substantial potential impact, losing a third of the expected growth boost.
Yeah.
Any other reactions noted in the sources?
Yes, the Investment Company Institute, representing major financial firms, also issued a warning stating the provision could limit foreign investment to the U.S., making the U.S. less attractive for foreign capital.
This feels like it introduces a bit of a contradiction within the president's stated goals. The sources pointed this out, didn't they, this tension?
They did. As the sources note, this bill introduces a fundamental tension within President Trump's policy agenda. On one hand, the administration talks about attracting foreign investment, making the U.S. competitive. But on the other hand, this bill could potentially impose significantly higher taxes on foreign profits and investors based here. It does feel contradictory.
What's the fate of this bill? Does it become law immediately now that it passed the House?
Not yet, no. It still needs to pass the Senate, where it's expected to face significant debate and, likely, opposition. Its future is uncertain. However, even the concerns about its potential passage have already been noted in the sources as having dimmed the outlook for the greenback, which is another name for the U.S. dollar.
Right. So even the proposal itself is having an impact on markets and currency outlooks.
Yes, policy uncertainty affects markets even before laws are finalized. That's a common theme.
Well, that was quite a whirlwind look at just 3 days, Juneteenth through 12th, 2025.
Yeah.
So stepping back, What does all of this really mean when we look at the pieces together? What's the big takeaway?
I think it shows a global economic narrative during this period defined by a really delicate balance, a balance of uncertainty and cautious optimism driven significantly by policy actions and reactions.
The World Bank's growth downgrade really sets that uncertain tone globally, doesn't it? It feels like the anchor point.
Absolutely. It powerfully underscores the widespread impact of trade tensions, but maybe more specifically, it emphasizes that unpredictability might be as damaging, if not more so, than the specific tariffs themselves in deterring business investment. It really highlights that a stable, predictable policy environment is key for global growth, especially, as we discussed, for developing economies, which stand to suffer the most from this volatility.
And we saw central banks trying to respond to this environment with their monetary tools, but facing those inherent limitations you mentioned earlier, especially when dealing with non-economic shocks like trade policy uncertainty.
Exactly. And their divergent approaches, the ECB's measured cut versus the RBI's more aggressive stimulus, really highlight distinct national economic conditions and, I guess, policy flexibility. India's move, with inflation well below target, shows a much more forceful push for growth.
Bringing it back to the U.S., the May inflation data seemed quite favorable on the surface, boosting hopes for Fed rate cuts. But that disinflationary trend looks like it's running up against some potential future challenges based on the other data.
Right. While the immediate data was good, it exists alongside those persistent tariff risks and the rising unit labor costs we talked about. The sources really hint that businesses might eventually have to pass those increased expenses on to you, the consumer. It suggests the White House's optimistic framing of current inflation might not capture the full picture of potential future price pressures. There's a potential lag effect.
And that decline in labor productivity, despite steady job and wage growth, points to a potential structural challenge, maybe. A strong labor market isn't translating into better efficiency, which, as you said, could raise questions about future inflation or squeeze business margins down the road.
It's a key dynamic to watch, for sure. And finally, on the policy front, while progress in U.S.-China trade talks offers a potential bright spot for easing tensions and maybe helping with supply chain issues.
That proposed U.S. House bill targeting unfair foreign taxes throws in a conflicting element, doesn't it? It could deter foreign investment and impact the dollar, creating a tension within the U.S. policy agenda itself.
Precisely. Its fate in the Senate is a significant factor to watch for businesses and investors trying to navigate this landscape.
So overall, this three-day window reveals a global economy navigating a really complex interplay of trade policy, central bank responses, and domestic fiscal debates. There were positive indicators, sure, but persistent uncertainties and structural challenges suggest the need for continued vigilance.
Definitely. And maybe here's something to mull over based on this deep dive. Given how frequently trade and fiscal policies seem to be the main drivers of uncertainty and market reactions right now, can traditional central bank monetary policy truly stabilize the global economy on its own? Or are we entering a phase where unpredictable political decisions have a more fundamental and maybe limiting impact on growth than purely economic levers?
That's a fascinating question to consider. Are the traditional tools enough anymore? Something definitely worth thinking about as we watch how these dynamics continue to play out.